Happy New Year. Happy 2025, everyone, clients and advisors. This is going to be an interesting year. I think most of us are interested to see how the first quarter plays out with the transition of power in the United States. And of course, beyond that, thinking about 2024 and how incredible it was for a very few set of companies within the S&P 500, the top 10 driving most of the returns for the S&P 500, driving it to another consecutive year of over 20% total return. And our feeling really hasn't changed very much regarding the outlook. We're still fairly concerned about the financials of many major corporations and the sustainability of earnings growth across certainly the top, where most of the concentration is the top companies within the S&P 500. So it's something that we'd like to see a bit more diversification within the U.S. stock market in terms of participation on the upside. Small and mid-cap companies in the United States are still lagging significantly behind the large cap and large cap growth counterparts in the U.S. Stock market. And so there's fantastic earnings growth that's been seen within those sectors of small and mid cap in the United States, but they haven't been participating and they haven't been rewarded by participants in the market the way these mega large cap growth companies have. So we'd like to see some of that broadening and breadth within the small and mid cap parts of the U.S. market in 2025. The financials are there, the fundamentals are there. The other thing that's quite an opportunity is the yields. 10-year U.S. Treasury is approaching 5%, and that is a very great thing to see in the economy. It's great for investors. It's great for fixed income investors in particular. And so in our portfolios, we have overweighted towards bonds relative to stocks globally, and with the specific interest that better yields drives better total return over time. And if we're able to buy into 6-7% investment grade corporates over the next year, that is incredibly powerful going forward in terms of total return for portfolios over the next 3 to 5 years. And of course, like we've done in the past, be very opportunistic with high yield bonds. And those are still displaying very, very compressed levels of spreads, which indicates very little concern or risk in the marketplace. So it'd be nice to see a little bit more risk perception around the high yield space. And if that happens, we'd have an opportunity to buy in at 7, 8, maybe even 9% of annual yields. And that's a fantastic opportunity because we cannot stay in ultra short-term U.S. Treasury bonds forever, which is where we've really been parked for quite a significant portion of our portfolio over the past couple of years. And that has served our portfolios very well. Very little volatility relative to broader markets, certainly relative to broad aggregate indexes for bonds. But going forward, we don't want to see that. We don't want to stay in ultra short term forever, and those yields should come down. And we should see more of a upward sloping yield curve as we progress through 2025. And the last part is looking at international non-U.S. stocks continue to display significant discounts relative to the U.S. stock market, specifically within the U.S. large cap part of the market. And there really isn't any reason why they should lag so much. So a bit of a catch-up would be very welcome, I think, for the capital markets. They certainly have earnings and stable earnings. And these are big multinational companies based out of Europe or other parts of the world in developed capital markets, and they're due to have some favor, and they certainly haven't been overbought, and certainly their valuations are very, very, very tame relative to the frothiness that we see in the U.S. stock market, the large cap part of the U.S. market. So those are really the key areas: looking for opportunities within fixed income and yields as risk perception changes, and also really favoring those lower valuation companies, whether it's the small and mid cap companies in the United States, or looking internationally also for those stable companies that are delivering great earnings and even earnings growth, but just haven't been favored, or haven't. Market participants haven't been so excited about these companies because there is no obvious or direct link to the artificial intelligence or AI euphoria that really swept through the marketplace so vehemently in 2024. But perhaps that euphoria will wane a bit here in 2025, and when that does, maybe the air comes out of the bubble a little bit. And certainly the big risks that we're concerned about are the refinancing risks for U.S. corporations. There's a huge wave that's coming due in 2025 and then again in 2026, because so many corporations refinance their debt at 1.5% interest rates in 2020 and 2021 with about 5-year paper. So those are coming due, and those refinance rates are much higher, triple at a minimum of what they had been previously. And there's only so many solutions that they can look to in the capital markets to refinance. And so many companies have been proactive, CFOs being proactive on refinancing, going to either the open public markets or going to private credit, or even going to their banking relationships. So we'll see how that plays out. Of course, we remain very vigilant to the day-to-day progression of these themes, and look forward to working with you further in 2025. Again, a very healthy and happy new year to you all.